On October 10, the crypto market didn't just dip. It was completely wiped clean. A sudden China tariff announcement triggered the largest liquidation event in crypto history, erasing billions in open interest and shaking investor confidence to its core. But just as the market started to catch its breath, Powell brought back optimism by hinting that quantitative tightening could soon come to an end. In this video, we're going to break down what really caused the crash, why Powell's comments could be the turning point for Bitcoin and altcoins, and how previous QT pauses have sparked some of the biggest crypto rallies in history. We'll also take a look at some emerging narratives, including the comeback of profitable ICOs and some potential airdrop opportunities that are catching attention. If you're here for data-driven insights without the hype, make sure to hit the like button. Really helps the channel grow and keeps us motivated to bring you these breakdowns. And of course, don't forget to subscribe so you don't miss what's coming next. Nothing in this video is financial advice. I'm just sharing my analysis and personal view of the market. Always do your own research and never invest more than you can afford to lose. Now let's get straight into it. Let's start with a quick forensic look at what the media called a crash, but what was really a large-scale deleveraging. The spark came from a geopolitical bombshell. President Trump announced a surprise 100% tariff on all critical software imports from China, escalating the trade war to a level not seen in years. This headline hit a market that was already over-leveraged to the long side, and the result was a chain reaction. Over $19 billion in positions were liquidated, making it the biggest single-day wipeout in crypto history. More than 1.6 million traders were forced out of their positions. It wasn't a fundamental failure of crypto itself, but a massive failure of risk management. The sell-off triggered a futures market contagion. As prices started falling, over-leveraged long positions began closing one after another, setting off a self-reinforcing cascade that drained liquidity across exchanges. The pressure was so intense that several platforms had to activate auto-deleveraging systems, forcing even profitable traders to close positions to protect solvency. In the aftermath, the market was left stunned. Bitcoin managed to bounce from lows near 107,000 back above 114,000, but traders remained cautious. Major altcoins showed weak recoveries and the entire space felt fragile, waiting for another shoe to drop from the ongoing trade tension. This crash highlighted a major evolution in crypto. It wasn't caused by an internal event or protocol failure. It came from a geopolitical headline that also hit traditional markets. Bitcoin's growing correlation with equities showed that crypto is now deeply integrated into global finance. That means it reacts to macro headlines like any other major asset. While this makes it more vulnerable to shocks, it also positions it perfectly to benefit when conditions turn favorable. Just when sentiment hit its lowest point, Powell stepped in and gave the market a spark of hope. His comments hinted at an upcoming end to quantitative tightening, marking a potential shift from draining liquidity to adding it back. For crypto, that could be a game-changer heading into the fourth quarter. Before we analyze how crypto behaved in past instances when QT ended, let's quickly understand what QT actually is and why it matters so much. Quantitative tightening is the opposite of money printing. It's the Federal Reserve reducing liquidity by shrinking its balance sheet, which means letting bonds mature without reinvesting the proceeds. You can think of it as the Fed vacuuming dollars out of the financial system to fight inflation. Less liquidity means tighter financial conditions, which is bad news for risk assets like crypto. During the COVID era, we had the opposite policy called quantitative easing, which injected trillions into the economy and sent markets into one of the most powerful rallies in history. So when the Fed hints that QT is ending, it's effectively signaling that the era of tight liquidity might be over. On October 14, Powell gave one of the clearest dovish signals we've heard in years. He said the Fed plans to halt its balance sheet reduction when bank reserves are at what he called an ample level. He then added a crucial line: that point could arrive in the coming months. For seasoned market watchers, that single phrase says everything. The vacuum cleaner is about to be turned off. The Fed's balance sheet has already shrunk by around $2.2 trillion, dropping from a peak of nearly $9 trillion to about $6.6 trillion today. Powell also noted that liquidity conditions are now tightening too much and could begin to hinder growth. That's a strong hint that the Fed is seeing stress in the system, stress that the recent crypto liquidation only made worse. This signals a clear pivot in priorities from fighting inflation to maintaining stability. And for risk assets, that's a major green light. It gets even better. This pause in QT isn't happening in isolation. The Fed has already begun cutting rates, with Powell confirming that more cuts are likely before the year ends. Market data shows an almost 100% probability of at least 2 more cuts by December. This combination of halting QT and lowering rates creates a powerful environment for risk-on behavior. liquidity stops draining, money becomes cheaper, and capital begins flowing out of safe havens into higher-yielding assets like crypto. To understand what this means, we can look at history. The last time the Fed stopped QT was in 2019. Back then, after 2 years of tightening, the system broke. The overnight lending market, known as the repo market, saw interest rates spike uncontrollably, signaling a severe liquidity shortage. The Fed was forced to abruptly end QT and start injecting cash again, first through emergency repo operations and later through treasury purchases that effectively restarted money printing. That shift triggered a powerful move across markets. Stocks rallied strongly into the end of 2019. Crypto didn't react immediately. Bitcoin actually drifted lower for several months, not because liquidity wasn't helping, but because that pivot came as a reaction to a crisis. It was messy, uncertain, and reactive, but the liquidity that returned in late 2019 built the foundation for what came next. It was the first domino that eventually led to the historic crypto bull run of 2021. The difference this time is that Powell is acting early. He's not reacting to a crisis. He's trying to prevent one. By signaling the end of QT before something breaks, he is essentially front-running a liquidity event. It's a clean, proactive shift rather than a panic move. Combine that with rate cuts and a crypto market now integrated into traditional finance through ETFs, and we have the setup for a major influx of capital. So does this mean a Q4 altcoin rally is locked in? In the days following the crash, market psychology flipped almost overnight. Fear was replaced by cautious optimism. We saw decent recoveries in large altcoins, showing there's still a strong underlying bid. The deleveraging event flushed out weak hands, and Powell's dovish stance provided a strong tailwind. Together, they've built the base for a potential breakout in the weeks ahead. This potential rally rests on three major pillars. The first is macro tailwinds. Easier monetary policy means more liquidity. The end of QT and upcoming rate cuts create a classic environment where investors move capital from safety to growth, chasing higher returns. The second pillar is institutional inflows. This cycle isn't being driven purely by retail traders. The launch of spot Bitcoin and ETH ETFs opened the doors for large institutional players to gain exposure in a regulated way. Following the crash, ETF inflows turned sharply positive again, with over $340 million entering in a single day. That's a strong sign that big money still sees crypto as a growth asset. Institutional participation also adds a layer of stability that previous cycles lacked. Surveys show that over 80% of institutions either already hold or plan to increase their crypto exposure this year. That's sticky capital, not speculative retail money. It gives Bitcoin and ETH a solid foundation, which then allows traders to confidently rotate into higher beta altcoins. The third pillar is powerful narratives. Crypto always runs on stories, and in Q4 2025, two sectors are stealing the spotlight. The first is the explosion of perpetual decentralized exchanges. For years, centralized exchanges dominated derivatives trading, but now that volume is rapidly moving on-chain. Platforms like Hyperliquid, Lighter, and Aster are competing aggressively, offering massive rewards to attract traders. Hyperliquid's airdrop alone was worth billions at its peak, and new protocols are following the same playbook, offering points that later convert into valuable tokens. This has created a massive incentive loop, drawing liquidity, boosting revenue, and fueling one of the most active on-chain markets we've ever seen. The second narrative is the revival of ICOs. But unlike the wild, unregulated days of 2017, today's ICOs are far more transparent and structured. They're happening on legitimate platforms backed by credible investors. Projects like Plasma and Umbra have already proven that this model can still generate massive upside when executed properly. And now, Mega ETH is set to launch its public ICO on Kobe's Sonar platform. It's one of the most anticipated ETH Layer 2s, backed by top-tier funds and with Vitalik Buterin himself participating as an angel investor. Registrations are open until October 27, and the hype around it is building fast. This new wave of ICOs and fair launches marks a major shift in how early-stage capital is raised in crypto, moving toward more transparent and community-driven models. I regularly share updates on these time-sensitive opportunities in our free community Discord and on X, so make sure you join us there. You'll find the links in the description. Also, let me know in the comments if you'd like a dedicated video covering upcoming ICOs and potential airdrop plays. If I see enough interest, I'll make it happen. So let's bring this all together. The October 10 crash wasn't the end of the bull run. It was a deep reset, a massive clearing event that wiped away excess leverage and gave the market a clean slate. Just as the dust settled, Jerome Powell gave the signal that the liquidity vacuum might finally stop. That combination of a structural reset, a dovish Fed, and growing institutional interest has built the strongest setup for altcoins that we've seen in years. The liquidity engines are turning back on. The macro backdrop is improving, and the crypto market, now more mature and better connected to global finance, is ready to capture that flow. The only question left is which sectors will lead it. That's my take, but I'd love to hear yours. Which altcoin sectors do you think will outperform in Q4? Drop your thoughts in the comments. If you found value in this breakdown, hit subscribe and turn on notifications so you don't miss the next update. Thanks for watching, and I'll see you in the next one.